Welcome to The Deep Dive, your shortcut to being well-informed. Today, we're diving into Estee Lauder's Q4 Fiscal 2025 earnings call. And it feels like a period that asks a really crucial question, doesn't it? Can a luxury beauty titan, built on tradition, exclusivity, truly reinvent itself for the TikTok age? Or is this beauty reimagined thing just a maybe desperate attempt to catch up? We'll dissect the strategic shifts, try to understand the challenges, and peek into what the future might hold.
It's an incredibly pertinent question. Estee Lauder is, undeniably in the midst of a significant and, you can see, often painful transformation.
Painful seems right.
Yeah. These results aren't just numbers on a page. They really reflect a company making difficult, yet probably necessary changes. Changes that could reshape not just its own future, but maybe the entire prestige beauty landscape.
Okay, let's unpack this then, starting with the snapshot of the results, because it really was a bit of a mixed bag for Q4.
Definitely mixed.
So on a GAAP basis, that's generally accepted accounting principles, right? The standard way companies report.
Right, the full picture, warts and all.
Exactly. On that basis, Estee Lauder actually reported a loss, $1.51 per share, which is a pretty sharp jump from last year's loss.
It is. And it was heavily influenced, as you said, by about $527 million in restructuring and impairment charges. Big numbers.
Huge. Plus $172 million tax adjustment on top. Quite the hit.
It was. But, if you strip out those one-time items, the non-GAAP or adjusted EPS, which arguably gives us a clearer picture of their core operational performance.
Yeah, the underlying business.
Right. That came in at 9 cents.
Yeah.
And that was pretty much right in line with what analysts were expecting.
Okay, so adjusted EPS met consensus. What about revenue?
Revenue for the quarter reached $3.41 billion. That actually slightly beat expectations.
Oh, interesting.
Yeah, but, and this is the big but, it did reflect a notable 12% year-over-year decline.
12%? Ouch.
Yeah, and the market's reaction. It was immediate, pretty pronounced. The stock saw a significant drop.
So investors clearly weren't thrilled.
No, it signals real apprehension, I think. Particularly around the near-term outlook and just the sheer ambition, the scale of the changes they're undertaking right now.
That market reaction definitely underscores the tension here. Okay, digging a bit deeper into the numbers. There were some interesting dynamics, right? Gross margin actually increased by about 230 basis points.
That's right, 2.3 percentage points. Hit a pretty healthy 74%, so they're holding on to margin on the products they are selling.
But the operating margin tells a different story.
It does. The full-year operating margin landed at 8%, which isn't terrible, but it was only 4% for Q4 itself. So that shows the pressure from, lower sales and those restructuring costs biting in the quarter.
Okay, got it. And what really stands out here, you mentioned, is the digital story.
Absolutely. Online sales hit an all-time high, now accounting for 31% of total sales.
31%? Wow.
Yeah, that's a 3 percentage point jump just from the previous fiscal year. And they expect this mix to climb even higher.
Okay, that's a bright spot.
It is. Yet, on the flip side, organic net sales, which strips out currency effects and acquisitions divestitures, fell about 8% for the full fiscal year.
And even worse in Q4.
Sharper, yeah. Down 13% in Q4. So this divergence, strong digital growth, but overall organic decline, it really underscores the internal shifts happening beneath the surface. Paint a picture of a company truly in flux.
So on one hand, these mixed financial signals, and on the other, a company actively kind of tearing itself apart and rebuilding. You mentioned significant transformation. What's the core idea driving this massive organizational overhaul? What are they actually calling it?
They're calling it Beauty Reimagined. And at its heart, it's what the CEO, Stéphane de La Faverie, described as literally the largest transformation in the company's history.
Largest ever. Bold claim.
It is, and it seems to be a bold three-pronged attack. First, deep operational restructuring and aggressive cost-cutting. We saw that in the GAAP numbers. Right. Second, an aggressive pivot to digital-first sales and marketing. That 31% figure speaks to that. And third, a hyper-focus on rapid, margin-accretive product innovation, getting new profitable products out faster.
And you mentioned this pivot isn't just a business decision. There's a symbolic element, too.
Yeah, I think so. It carries immense symbolic weight, coming after the passing of Chairman Emeritus Leonard A. Lauder back in June 2025. Management has explicitly stated their commitment to regaining prestige beauty leadership in his honor. That suggests, A deep, maybe almost emotional conviction behind this. It might propel this transformation more fiercely than just a purely financial mandate would.
That's a powerful narrative driving it. And that jarring GAAP loss we mentioned earlier, a direct consequence, you said.
Directly, yes. Significant restructuring and impairment charges.
Then the job cuts are real. They've already completed 3,200.
Correct. With the potential for up to 7,000 in total.
7,000 jobs. That's a staggering 12% of their global workforce.
It's huge. And the total restructuring charges are expected to hit somewhere between $1.2 billion and $1.6 billion.
Billion with a B.
Wow. But here's the potential upside, right? These bold efficiencies, these cuts, are projected to generate annual cost savings of $800 million to $1 billion annually.
Okay, that's significant savings. And what are they doing with that money?
Management explicitly plans to reinvest those savings into consumer-facing growth initiatives, things like marketing, innovation, digital. That's crucial for their long-term vision.
Makes sense. And there were also impairment charges, specific brands.
Yeah, Q4 also saw $425 million in impairment charges specifically related to the Dr. Jart and Too Faced brands.
Ah, okay. Why those?
It seems to reflect a challenging environment, particularly in mainland China and Korea, where those brands have exposure, and also some underperformance in other key geographies. It signals they're, not afraid to make tough calls on assets that aren't performing as expected.
So beyond the headcount reductions, how are they physically streamlining the organization to get these savings?
Operationally, they're really simplifying the structure. A big move is consolidating 7 regions down into 4.
4 main regions now.
Yeah. Americas, UK, Asia, and travel retail. With China remaining as a standalone region, given its strategic importance.
Right. China's always a special case.
Always. And significantly, P&L responsibility, profit and loss has shifted away from the individual brands and onto these new regions. That happened July 1st.
What's the thinking there?
The aim seems to be greater local agility and accountability, letting regions make decisions closer to the market. Plus, they mentioned a new R&D head is expected to be announced soon, which will complete the new leadership team for this leaner structure.
And outsourcing.
Yes, they're also rapidly advancing outsourcing initiatives to optimize their cost structure, trying to get closer to industry benchmarks, basically. It's a pretty holistic approach, trying to create a leaner, more agile organization top to bottom.
And that focus on optimization, it isn't just about internal processes, right? It extends directly to how they reach their customers.
Exactly. A truly key initiative is undoubtedly this aggressive push into online channels, transforming their sales landscape.
Which brings us back to that 31% digital sales figure.
Right. An all-time high, as we said. And what's fascinating here is how they're expanding digitally. It's not just their own sites.
Amazon is a big part of it.
A huge part. Estee Lauder has significantly scaled its presence on Amazon. You've got powerhouse brands like The Ordinary, Clinique, Origins, Aveda now available there in the U.S., Canada, Mexico, the U.K.
How many storefronts are we talking?
Currently 11 Estee Lauder brand storefronts just on U.S. Amazon Premium Beauty and 3 in Canada.
So they're really leaning there and elsewhere online.
Yep. In Southeast Asia, they've also ramped up their presence on platforms like Shopee and TikTok Shop.
TikTok Shop. Interesting for a prestige brand.
It is. This whole strategy isn't just about moving product online. It feels like a fundamental challenge to the traditional luxury retail model. They're aiming to reduce reliance on traditional department stores, particularly in North America.
Which have been struggling anyway.
Precisely. And they see Amazon also acting as a kind of megaphone for overall brand awareness, which is a stark shift from the, careful exclusivity luxury brands once guarded so closely.
Yeah, that's a major pivot. So we're seeing these deep operational changes, a fundamental shift in sales channels. But what about the products themselves? Are they evolving the portfolio too?
Absolutely. They're completely realigning their innovation portfolio. The main goal seems to be delivering gross margin accretive products faster.
Meaning new products that directly boost their profit margins.
Exactly. Not just newness for newness' sake. They're focusing on high growth segments. Skincare is big, with an emphasis on things like night longevity and derm-focused solutions. Also luxury fragrance, hair care, and makeup too.
And they're ambitious about the speed of this.
Very ambitious. The goal for fiscal 2026 is for innovation new products to represent over 25% of their total sales.
A quarter of sales from new stuff.
Yeah. And they have an ambition to triple the percentage of innovation launched within just 1 year, from 10% historically to 30%.
Wow, that's a huge leap in innovation speed. Any recent highlights that kind of illustrate this shift?
Definitely. Recent successes include things like La Mer's Balancing Treatment Lotion, Clinique's Supercharged SPF DDML, quite a mouthful.
Yeah.
And The Ordinary's UV Filter SPF 45 Serum. We've also seen the, frankly, remarkable expansion of Clinique's Almost Lipstick franchise.
Oh, yeah, that blew up on social media, right?
Totally. It leveraged social media virality to grow volumes over 30 times in just 4 years. It's a prime example of a legacy brand recognizing and really capitalizing on emerging trends and platforms.
Yeah, and they're not just innovating the products, but also how they market them. Something about AI.
Right. The company is deploying a new media model, more focus on actual demand generation, not just brand awareness.
Yeah.
And they're leveraging AI-powered marketing tools.
Is it working?
Seems like it.
Yeah.
They reported that this AI-powered approach has already driven a 31% increase in ROI from their North American media campaigns. So early positive signs there.
Okay. And they're thinking outside the box in other ways, too.
Yeah, they're clearly trying different things to capture new audiences.
Oh.
Beyond AI, we're even seeing the relaunched RM brand, its Intrusion fragrance, now being fronted by global ambassador Dwayne Wade.
Dwayne Wade, the basketball player.
The very same. It's a smart, high-profile move, grabs broader attention, perhaps taps into demographics they haven't traditionally dominated.
From AI to D. Wade, quite the spectrum of influence.
Okay, now let's pivot to regional performance. That overall 12% revenue decline wasn't uniform, you said. Travel retail got hit hard.
Hit really hard. It plummeted a staggering 28% just in Q4 alone.
28%, that's huge.
Yeah. And that significantly contributed to the overall 8% organic sales decline for the full fiscal year. Travel retail now accounts for only 15% of reported sales.
15, what was it before?
At its peak during the pandemic, it was 29%. So a massive drop in its contribution.
Why the big decline there? Still inventory issues. That seems to be the main factor. Still working through inventory built up post-reopening. Management expects it to return to growth, but only around the midpoint of its fiscal 2026 outlook. So a slow recovery expected there.
And across product categories, any bright spots in Q4?
Not really in Q4 specifically. All the major product categories saw declines. Skincare is down 16%, makeup down 11%, hair care down 10%. Fragrance actually remained flat, which shows some relative resilience, I suppose.
Okay. And regionally, besides travel retail?
Well, for the full fiscal year 2025, the Americas, Asia Pacific, and EMEA all experienced downturns overall.
Right. Now, here's where it gets really interesting for me. China, a market that's been tough for many. What are they seeing there?
Yeah. Despite previous weakness, the company is actually reporting early signs of stabilization in mainland China.
Stabilization? That's positive.
It is. And they're even claiming share gains, driven by key brands like La Mer, Tom Ford, and the core Estee Lauder brand. They actually achieved high single-digit retail sales growth in Q3 and Q4.
Retail sales, so what people are actually buying in stores or online there.
Exactly. Sell out, not just sell into distributors. So how confident are they about this turnaround?
Yeah, what's the outlook for China?
They're cautiously optimistic, I'd say. The fiscal 2026 guidance assumes mid-single-digit net sales growth in mainland China. It's a positive signal, but still, pretty modest compared to past growth rates.
Okay. And North America?
North America also saw sequential improvement and market share gains in the second half of fiscal 2025, largely driven, it seems, by those diversified channels we talked about, including that Amazon expansion.
So Amazon's helping in the U.S. too. What about Europe?
Europe, however, seems to be facing a sequential slowing in prestige beauty, particularly in main markets like France and Germany.
Why is that?
Sounds like eroding consumer sentiment, people feeling less confident economically. They're deploying strategic investments and accelerated innovation there to try and address this, but it paints a more challenging picture for Europe right now.
And what about new frontiers? Emerging markets, they're only 10% of sales now.
Right, only 10% currently. But that's exactly why they're seen as a significant untapped potential, high potential for double-digit growth down the line. It's clearly a future growth engine they plan to lean into once they stabilize the core markets.
Makes sense. Okay, shifting gears slightly. Pricing and inventory. Are they raising prices?
They are leveraging their pricing power, yes, but selectively. There are some low single-digit increases embedded in the fiscal 2026 outlook. However, it's nuanced. They're also strategically introducing new innovations across different prestige price tiers. And interestingly, they've even reduced prices on some older historical products while significantly cutting back on overall discounting.
So a more complex pricing strategy, not just straight hikes.
Exactly. Trying to balance value and prestige.
And inventory management. You mentioned that was key in travel retail.
Absolutely crucial everywhere, really. They've made considerable progress, they say, in reducing trade inventory levels across key markets. Travel retail, China, the U.S., getting inventories better aligned with actual forecasted demand.
Why is that so important right now?
Well, the goal for fiscal 2026 is to further narrow the gap between retail sales and net sales. That's the sell-in versus sell-out gap we talked about with China. Reducing that difference means less product sitting unsold on retailer shelves. That leads to much healthier inventory management, fewer potential write-offs down the line, and ultimately better cash flow for Estee Lauder.
Got it. Okay, so let's look ahead to fiscal 2026. The guidance they gave sounds cautious.
Definitely cautious is the word. The company expects adjusted EPS between $1.90 and $2.10.
Which is below what analysts were hoping for.
Yeah, falls below the consensus estimate, which was around $2.20. So that likely contributed to the negative stock reaction.
And organic sales growth, also modest.
Projected at a modest 2.5%. Some sources even narrowed that forecast down to 2-3%, so signaling a very cautious return to top-line growth.
Are there specific headwinds they called out?
Yes, a significant one will be an estimated $100 million impact from tariffs. Unspecified which ones, but likely related to trade dynamics. They're actively pursuing mitigation strategies, but it's a drag.
Okay. And margins. Are they expecting improvement there from all the cost cuts?
They are targeting an operating margin between 9.4% and 9.9%. That reflects about a 165 basis point expansion at the midpoint. So improvement, yes.
Driven by the restructuring?
Primarily driven by continued benefits from their PRGP, that's their profit recovery and growth plan, particularly in SG&A costs. Selling, general and administrative. They expect greater margin expansion in the second half of the fiscal year as more benefit to kick in.
What about cash flow?
Net cash flows from operating activities are projected between $1 billion and $1.1 billion. That reflects the anticipated peak restructuring payments going out the door. So cash flow might be constrained short-term by those payments.
And their overall assumption for the beauty market?
The guidance assumes pretty modest global prestige beauty growth overall, just 2-3%. So they're not counting on a booming market to lift them up.
Right. Despite those cautious numbers, though, management seemed to express confidence.
They did. They pointed to positive developments like the stabilization signs in China, the difficult but necessary inventory work getting done in travel retail, and those retail share gains in North America. All supported, they argue, by the PRGP execution.
So it sounds like they're framing it as the short-term pain is absolutely essential for the long-term gain they're aiming for.
That's exactly the message. From an investor context, you have Estee Lauder navigating this really complex luxury beauty landscape. You've got weak global demand in pockets, persistent challenges in travel retail, trade policy uncertainties, especially in Asia.
A lot to juggle.
A huge amount. And this beauty reimagined strategy is undeniably a bold multi-year plan, trying to create a leaner, more agile organization.
Right.
But as we saw with the market reaction, the substantial restructuring costs in that cautious guidance represent a, well, tough pill for investors to swallow in the short term.
It highlights that classic tension, right? Short-term profitability concerns versus management's long-term vision.
Exactly. It indicates the market is really focused on the immediate bottom line right now.
And it's interesting because prior to this earnings call, the stock was actually doing pretty well this year.
Yeah, it was up approximately 14.2% year to date, actually outperforming the S&P 500.
So there was a degree of market confidence in their strategic direction before this report.
There seemed to be, yes, which is now being rigorously tested by the specifics of this Q4 report, and particularly that forward outlook for fiscal 26.
So what the company is signaling is really a transformational pivot, shifting its whole playbook maybe from just extensive growth to a much more disciplined, digitally savvy, and operationally efficient model.
Precisely. And the success of this whole transformation, it really hinges on their ability to stabilize key markets, particularly China, where we're seeing those early positive signs. And also, crucially, their ability to effectively shift that channel mix, less department store, more online, more Amazon, to meet where consumers actually are today. If they can do that, it lays the foundation for what they hope is more sustainable and, importantly, more margin-rich growth in the future.
All right, now for our This Is Not Financial Advice segment. Time for a wild yet plausible thought experiment for the adventurous investor listening in. And let me stress again, these are just ideas for discussion, purely hypothetical, based on the insights we've uncovered today, not recommendations.
Absolutely. Okay, so given Estee Lauder's really aggressive pivot towards online and these specialty multi-retailers like Amazon and their stated intent to reduce department store exposure, here's a thought. A compelling long-term pair trade might be to, say, buy call options on EL Estee Lauder stock, maybe with a 12-month expiry, giving the strategy time to work.
So betting that Estee Lauder's stock price goes up over the next year.
Right. And you pair that with shorting a basket of regional department store equities.
So betting that department store stocks will go down.
Exactly. The thesis is EL successfully executes its digital and channel transformation, driving that sustained margin-rich growth we talked about. Meanwhile, traditional department stores, perhaps losing key anchor brands like Estee Lauder, continue their secular decline, maybe even accelerated by these kinds of brand defections. The options premium you pay on Estee Lauder hedges you somewhat against short-term volatility from all the restructuring noise.
Right, gives you upside potential without buying the stock outright immediately.
While the short position in the department store basket provides a potential structural tailwind if that retail landscape shift continues as expected.
Okay, that's one idea. Complex but interesting logic. Got another one?
Sure. Alternatively, for the truly contrarian out there, you could consider buying long-dated put options on a high-growth, pure-play online beauty retailer.
Betting that one of the newer online-only players might struggle.
Potentially. And you'd hedge that bet with a long position in EL shares themselves.
Okay, explain the thinking there.
The idea is, what if Estee Lauder, with its huge portfolio of established brands and this newfound digital agility post-restructuring, actually starts reclaiming significant market share in the online prestige beauty space? That could put serious pressure on some of the smaller, pure-play digital competitors whose valuations might already be stretched thin, EL's established brand equity and their improving operational efficiencies could allow them to outcompete or maybe even acquire some of these nimbler players down the road. It could create a unique kind of arbitrage opportunity between the incumbent and the disruptors.
Betting on the giant waking up and flexing its muscles online. Another interesting, if speculative, angle. Okay, so to recap this whole thing, Estee Lauder's Q4 was definitely challenging on that GAAP basis, mainly due to the huge restructuring costs. But the adjusted EPS did meet expectations.
Right, and this Beauty Reimagined strategy is clearly a monumental undertaking. Focuses squarely on cost savings, big digital expansion, and operational efficiency to drive future growth.
And while the market reacted negatively to the short-term guidance and all those transformation costs, management is clearly betting heavily on these structural changes to deliver long-term value. So, maybe the final question for listeners to ponder is, which aspects of this massive transformation do you think will be most impactful in truly reshaping the luxury beauty market over, say, the next decade? Something to mull over. And just one last time, please remember, this discussion is purely for informational purposes only. It absolutely does not constitute financial advice. We strongly encourage all our listeners to conduct their own thorough research and consult with a qualified financial advisor before making any investment decisions. We appreciate your insights today.
Always a pleasure. It's a fascinating story to watch unfold.
It really is. We look forward to hearing your thoughts on Estee Lauder's journey. Until next time, keep those stickers talking.